What does it really mean to use leverage? Imagine you're in a bustling casino, the air thick with excitement, and the sound of chips clattering. You're feeling lucky, but here's the catch. You don't have enough cash to make that big bet you've been eyeing. So, you decide to borrow some money from a friend. With that extra cash in hand, you can place a much larger bet than you could on your own. Now, why would you do this? It's simple. Leverage allows you to amplify your potential returns. Let's say your friend lends you $1,000 and you combine that with your own $500. Instead of betting just $500, you're now wielding a whopping $1,500. If you win, your profits skyrocket because you're playing with a bigger amount than you initially had. But here's the surprising part. That borrowed money also means you're taking on more risk. Imagine the flip side. You place your bet, but the odds don't go your way, and you lose. You've lost not just your $500, but also your friend's $1,000. Suddenly, what started as a thrilling adventure turns into a high-stakes gamble with serious consequences. In the world of trading, it's the same concept. Traders use leverage to control larger positions in the market without needing the full amount up front. It can lead to greater profits, but it also amplifies losses. Understanding how this works is crucial, because while leverage can boost your potential gains, it can just as easily deepen your losses if things don't go as planned. So, when you hear about leverage, remember it's a double-edged sword. Powerful, yet perilous. If you're curious about how this plays out in the market, stick around for more insights. You're sitting at a trading desk, and in front of you is a big screen flashing numbers and charts. Among the buzz, you notice a section that catches your eye. Leverage. You take a moment to wrap your head around it. So what does leverage really mean in practice? Imagine you're at a poker table, and you've got $1,000 in chips. Now the dealer offers you a special deal. For every dollar you put in, you can bet $10. That's right. With 10x leverage, your $1,000 lets you control a whopping $10,000 worth of chips on the table.
That's tempting, isn't it?
Let's break that down. You put up your $1,000 as collateral, and the broker or trading platform lends you the other $9,000. This means you can amplify your potential gains because you're playing with more money. If your bet wins, say you make a 10% profit, you're looking at $1,000 profit instead of just $100. That sounds great, right? But here's the kicker. If the hand doesn't go your way, you're still liable for that entire $10,000 position. If you lose even a small percentage, the losses multiply just as quickly. If you lose 10%, that's a $1,000 hit, wiping out your entire investment. The stakes are much higher than they seem at first glance. So while leverage can magnify your gains, it also magnifies your losses. You're not just betting on your money, you're betting on borrowed money. That's why understanding how leverage works is crucial before you step into the game. Now that you see the mechanics at play, it's time to dig deeper into the dangers lurking within leverage. Vocabulary: leverage, collateral, amplify. Now, picture this. You've invested $1,000 in a stock that increases in value by 10%. Without leverage, you're celebrating a $100 gain. Not bad, but it's just a small bump. Now, let's add some leverage into the mix. Imagine you're allowed to borrow money to amplify your investment. Let's say you're using 5 times leverage. That means you can control $5,000 of stock with just your $1,000. So if that stock rises by 10%, it's not just your original investment that's gaining value. You're now looking at a $500 profit. That's 5 times what you'd earn without leverage. It's like using a magnifying glass on your gains, turning a modest return into something much more significant, almost instantly. And here's the surprising part. With leverage, you're not just amplifying gains, you're also tapping into opportunities that you might not have had the capital to engage with otherwise. Think of it like renting a car to go on a road trip. You get to experience the journey without needing to buy the vehicle outright. In the investment world, leverage can open doors to higher-priced assets, letting you participate in markets that can lead to larger profits. But remember, while the potential for bigger gains is enticing, it comes with its own set of risks that we'll dive into next. So as you consider using leverage, keep in mind that understanding both sides of the equation is crucial. But here's the surprising part. Leverage isn't just a tool for gains, it can turn against you in a heartbeat. Imagine you're sitting in seat 23A of a plane, soaring through the clouds after having just hit a jackpot with your leveraged investment. You're feeling invincible. But then the pilot announces turbulence ahead. You might think, no big deal, I've got this. Now let's say you leveraged your investment by borrowing money to make it bigger. You put down $1,000 of your own cash and borrowed another $9,000, giving you a total of $10,000 to invest. If your asset goes up by just 10%, you celebrate a fantastic $1,000 gain. Your initial investment has doubled. But what happens if the market takes a turn and your investment drops by just 10%? You might think, that's only $1,000, I can handle that. But since you leveraged your position, that drop doesn't just affect your initial investment. You still owe that $9,000 you borrowed. With a 10% loss on a $10,000 investment, you lose $1,000 of value, which wipes out your entire $1,000 deposit. Suddenly, you're not just down a little, you've lost everything you put in. It's like taking a roller coaster ride with no safety harness. The thrill of leverage can be intoxicating, but the fall can be devastating. This is why many experts urge caution. With leverage, the potential for greater gains comes with an equally significant risk of loss, which can happen fast. So, while leverage can amplify your investments, it's crucial to understand the risks involved. Once you grasp this double-edged nature of leverage, you're better equipped to navigate its thrilling yet perilous landscape. If you found this insight helpful, consider subscribing for more deep dives into the world of finance. Imagine you're sitting at your desk, staring at your trading account. The numbers are flashing and you notice your balance is dropping. You used leverage to amplify your trades, but now the market isn't in your favor. Suddenly, an alert pops up on your screen. It's a margin call from your broker. They're demanding more money to cover your losses. So what does this mean? When you trade with leverage, you're borrowing money from your broker to increase your buying power. Suppose you have $1,000 and decide to use 10x leverage. This means you can control $10,000 worth of assets. Sounds great, right? But here's the catch. If the value of your assets falls even slightly, your broker wants to ensure they aren't left holding the bag. You're now faced with a choice. The broker requires additional funds to keep your position open. You have to deposit more cash into your account to meet the minimum requirement. If you can't, here's the surprising part. Your broker has the right to sell off your assets. This is called liquidation, and it locks in your losses. That means even if the market eventually turns around, you're out of the game, and your investment is gone. Think of it like a game of poker. You've raised your bet, hoping to win big, but if the cards don't fall your way, you could lose your entire stack in a single hand. With margin calls and liquidation, it's the same risk. Only now, the house always has the final say. So understanding how leverage works is crucial. It's not just about expanding your potential profits. It's also about understanding the risks and the reality of margin calls. If you don't have more cash ready to go, you might find yourself losing not just your position, but your initial investment too. As you navigate the world of trading, keep in mind, and a 10% decrease can mean you lose your entire investment, and then some if you're not careful. This is why the concept of margin calls and liquidation is so critical. If the market moves against you, your broker may demand you deposit more funds to cover potential losses, and if you can't, your position could be liquidated at a loss. So always remember, what goes up can come down just as fast. Understanding the true nature of leverage can help you make informed decisions. If you found this insight helpful and want to dive deeper into the markets, consider subscribing for more.